Now, I don't know about you, but if I'm going to take unlimited risk, I want to get paid for taking unlimited risk. Like if I'm going to sit through the inevitable 2, 3, maybe 7 standard deviation move, I want to get paid. I want to get compensated for absorbing that potential risk. Now, again, when it comes to trading and investing, you have to make up your own mind. I cannot tell you what to do. I would never even try to tell you what to do. I am just a faceless gnome wandering through the wilderness. You are a faceless gnome wandering through the wilderness, and just by pure chance, our paths have happened to cross. But in the event that you too, hypothetically, theoretically, in some fictitious world that of course does not exist, want to do something similar, where you would also like to get paid for the risk that you are taking on your trades, here's one of the best things that you can do to accomplish that objective. Don't feel the need to take them all the way to expiration and squeeze every drop of juice out of that orange. Run those guys all the way down to the end where the hourglass is empty. There are no more crystals left. It's not necessary. Leave a little bit on the table. Leave a little bit for the next guy. Why should you consider this? I'm going to give you 3 reasons, 2 that are theoretical and 1 that is quite practical and very empirical. So the first reason is gamma risk. Whenever you trade an option, you are exposed to all the Greeks that come off of the Black-Scholes option pricing model. Delta, theta, vega, rho. Shout out to all my rho scalpers out there. All 3 of you might be watching this very video, so I appreciate you guys. I appreciate you guys very, very much. Well, another Greek that is of special importance is gamma. Gamma is a second derivative of the Black-Scholes option pricing model, and it measures how delta moves when the underlying stock price moves. So delta measures how the option price moves when the underlying stock moves, and gamma measures how delta itself moves as the underlying stock moves. So the relationship here is no different than when you're driving a car. For example, when I gassed up the 2011 Honda Civic and I hit the streets, and I'm ready to smoke some of these homeschooling moms off the line in their Chrysler Pacificas, the 2 ways that I'm going to do it are through speed and acceleration. Well, delta and gamma are exactly the same. Think of delta as measuring the speed of the directional moves against you, and think of gamma as measuring the acceleration of the directional moves against you. And we know as an option seller, the thing that's going to do the most damage is going to be the big outlier directional move against us. And so these essentially measure 2 different layers of how damaging that directional move could be, the speed of it and the acceleration of it. Without even getting into the specific numbers or digging into the derivation of gamma from the Black-Scholes model, just knowing that option gammas are low early in the expiration cycle and get much higher near the end of the expiration cycle can really help you mitigate your gamma exposure, which again helps to minimize the directional moves against you, which can begin to accelerate and do a lot of damage rather quickly. So by managing our trades, that means either closing them or rolling them at least a couple of weeks prior to expiration, we can do a lot to just naturally minimize the gamma exposure that we're going to have on our short options positions. Okay, the second reason, premium decay. If we think about an option's moneyness, in the money, at the money, or out of the money, the actual state of moneyness of the option is going to largely impact and influence how that premium does decay over time. It's not going to be the same. It's not going to be universal. It's not going to be static. Whatever moneyness state that option might be living in is going to play a big role in determining what the premium dissipation or decay over time is going to look and feel like. For instance, if you look at this graphic, it shows the various differences in premium decays by moneyness. And the key thing to notice is look at that out of the money curve. Right inside of that 60-day marker, you see the premium decay starts accelerating. In other words, the premium is melting off the option quickly, which is exactly what we want as an option seller. Okay, fair enough. But now look at what happens when you get close to expiration. It levels off a lot, which means the premium isn't coming off the option as efficiently as it was earlier in the cycle. So what does that mean in English? It means you're not getting paid for the risk anymore. It means you are not getting paid for essentially the same risk that you were taking earlier in the trade. You're just not being compensated by the passage of time, the natural decay of the option, like you were previously or at earlier points in the life of the trade. It has leveled off quite a bit, and that premium decay is drying up. So essentially, if you have an out of the money option and it has done its job, you've had the trade on for a couple of weeks. You've had the trade on for a month. You've had the trade on for, 23 days, whatever it's been. It has done its job. Book the winner and move on. Now, you can look at that graph and you can get super granular. You can start to dissect it like, wait a minute, Jim, is it 61 to 32? Is it 47 to 25? Is it 33 to 16? And the answer is yes. The main point is when you have an out of the money option and it's done its job, just take the off ramp. Take the off ramp, move on to the next trade, and call it a day. The third reason, and this is the empirical one, the Tasty research has showed over and over and over again that the first half of the expiration cycle was far more reliable than the second half of the cycle when it comes to your P&L. The P&L returns were closer to what was expected, and the P&L volatility was smoother along the ride. I mean, that sounds to me like a gimme and a gimme, which that doesn't happen too often. In fact, it's actually never supposed to happen. But if you actually think about the things we've already addressed, it actually makes perfect sense. I mean, just 4 minutes ago, we were talking about gamma risk and we were talking about lower gammas earlier in the cycle. Okay, I should expect better P&L results earlier in the cycle because gamma is not as potent. Gamma is not as strong. It can't do as much damage. Okay, that makes sense. Well, we just talked about, 2 minutes ago, out of the money decay curves. So now I'm getting paid more per unit of risk. Like I'm absorbing better premium decays over time between 60 and 30 or 45 and 22, basically the first half of that cycle. So that also kind of leads to a natural conclusion that I should reasonably expect better results in that first half of the cycle. And thinking about it even more broadly, in like super practical terms, this actually makes perfect sense because when you put a trade on, what is the moneyness status of that trade 9 times out of 10 or 8.5 times out of 10? It's out of the money. Yeah, every once in a while we might sell an at the money putter. Every once in a while we may try to, beat the system and cheat death by selling an in the money putter, what have you. But that's not the default setting. We're selling out of the money premium. Okay, if I'm selling out of the money premium, the deltas are naturally low early in the cycle. My deltas are naturally 30, 35, 40, 27, what have you. And so generally speaking, they're not going to do as much damage when the directional moves do hit me early in that cycle. It's later in the cycle when now my deltas are 50, now my deltas are 57, now my deltas are 77 if they happen to be similar to my own trades. So now the directional moves absolutely can do some damage. So just by the sheer nature of it being early in the trade, the option spending most of its time in that out of the money state, it makes perfect sense that the first half of the cycle would lead to smoother and closer to expected results. So that is why, as a premium seller, booking your winners long before expiration is a strategic way to play these positions. But let me know down in the comments, man. I want to know. The algo is dying to know. Do you manage your short options positions early, or do you play it from the dark side and take that guy all the way to expiration? Drop down there, pump that algo, sign up for the trading lab. It's free down there in the description, and I will see you guys next time.